Welcome, Brett, to another episode of Rebuild Confidence. You look like really serious, Brett. What's
I was just waiting for you to actually remember the name of the
I know, I keep forgetting. We've only just named it because we decided we needed a name. We've only decided in the last couple of months that we're podcasters. Yeah, it's not quite like the Kardashians, is it? Much better looking. We're going to have a chat today, Brett and I, about something that's happening in the market, the insurance market at the moment, that it's kind of new to us. We've seen it a couple of times, but it's not really affected as much. But we've got lots of questions because we're not really seeing that market, and there's lots. I think our questions come more from just inquisitive questions like we did when we first started doing rebuild valuations and asking questions that nobody asks. We're asking the dumb questions.
Yeah, I guess we are.
Yeah.
Hopefully coming up with not dumb answers.
In my experience in insurance industry, everybody talks in acronyms and talks about different things, and everybody just nods their head. And I suspect a lot of them don't actually know what it all is.
Yeah. Well, that'll be interesting. I guess we'll get that feedback.
So we're going to talk about a soft insurance market today and what it means, how we're here, what the difference is between a hard insurance market, a soft insurance market, and what we see in the market and what we find quite odd in the market and how we see the way forward and how we can help. Does that give an idea, Brett?
Pretty much.
Yeah. So Brett's our in-house expert.
Just nominated 5 minutes ago.
Yeah, we decided that Brett knows probably about one sentence more than me about this, so I'm going to ask him a few questions. So Brett, soft market, tell me what it is and tell me what happens.
Okay.
In the insurance industry.
I'll start off with a story because I do like telling stories, and I know we've got a bit of a timeline. But
if you hear me snoring.
That's right. We've been hearing soft market mentioned a lot, probably over the last sort of started for us, probably because we didn't really know what it was about a year ago, and then it just kept coming up and coming up and coming up. We've just done our Beyond the Build, and a lot of discussions that we had with insurers and brokers. They were talking about the soft market. And so we just asked the question, which seemed quite dumb to them, is what is the soft market and what does it mean? And we've been talking about it in-house to try and strategize around how we could move within that market. First of all, we had to understand what it was and how we can move around it and how we can help people in the market the way it is. To start off with hard market, which we've had since COVID really, is where my understanding is there wasn't a lot of capacity around in the insurance companies. They were really risk averse and they wanted updated some insurance valuations.
So what happens to the end customer? So we're just starting on describing what a hard market is, which is great. What is the outcome for an end customer for Mr. and Mrs. Joe Blogs?
In a hard market? Yeah, well, generally there's higher premiums because there's not a lot of competition.
Yeah.
And from what I understand, I'm just about to use the word dictate, but which probably won't go down too well, but insurers tend to dictate the market. Regulation seems to be quite high where they actually ask for evaluations, which obviously helps us out because that's what we provide. And premiums if go up, they're affected accordingly.
And that comes from the reinsurers as well. So it's the reinsurers, whether they've got loads of cash and they're willing to take lots of risk,
that's it,
or they're not willing to take lots of risk, which is a hard market.
That's right.
Is that,
I think we'll agree that's how we understand it, and I'm sure people will tell us otherwise, but we've done a bit of reading on it, like 5
Doesn't
minutes.
mean we're right. happy for people to tell us.
Yeah, exactly. And then moving on to the soft market, which is where we're at the moment, is there's a bit of competition out there. So there's a competition in the insurers and the reinsurers. There's a lot more capacity. And so it's a lot better for the end user, as in the client, and what we're finding, like some of the trends is, and what we're hearing about is clients are just moving from insurance company to insurance company to be able to get the most discounted rate and premium.
Yep.
And I guess one of the alarming things that sort of come to mind the other day that we were discussing about is the insurance companies don't seem to be too worried about getting up-to-date valuations as much as what they were during the hard market. which we found a little bit confusing because...
So they're a bit more open to bigger risks then in a soft market, would you say?
Yeah, I think that's what it is.
They just want to sell product.
Yep. And it's a competitive market for them.
Yep.
So the only way they can sort of sell product is to be competitive.
And so the brokers who are protecting their customers are happy to just not have a rebuild valuation as well, and the insurer. So everybody's running into this risk pool.
Yeah. Well, I'm just going to give you an answer on behalf of all the insurers and brokers out there. And my study of all the people that I've spoken to recently is I don't think anybody's really happy about a soft market.
Yeah.
Because what it does do is it does potentially drive a bit more risk because they've got to be competitive. And it might mean that the service that we provide is seen as not as important as what it was during a hard market, because some of the insurers would just put an inflationary rollover figure on it, or they won't insist on actually on clients having the accurate sum insurance value.
So we've got a big issue in New Zealand that we've got two insurance companies that run the market, and they've got, between them, they've probably got 80%, 90% of the market, and they dictate what happens.
Yep.
And they decide whether it's they make a soft market and they make a hard market by deciding whether they need to sell product or not.
Yeah.
That's a big, it's a bit like the, I don't want to say this, but I am going to, a bit like supermarkets, isn't it? It's a bit, when you've got that, two companies with that much power, they dictate the market.
Yeah, I don't know enough of it, but to be able to explain my way through that, but obviously they're influenced by the world market as well.
Oh yeah, and the reinsurance market.
Yeah.
That's how they are buying insurance is how we all end up where we are. And the soft market's great for the customer.
It is.
But we need to make sure that they're still protected and we're still getting the right sum insured and they're actually still getting the right advice and proper professional advice.
Yeah. And I mean, it's a soft market, but on top of that, we're in a economic recessionary period as well, which makes it worse because there's not a lot of money out there. So people are trying to cut costs as much as they can. And if one of those cost-cutting exercises is not
tongue twister there.
Potentially. I'm actually going to say, and one of the potential cost-cutting exercises is actually not getting an up-to-date valuation some insurance valuation to tell them what the actual risk is.
Absolutely. And people see it as a grudge purchase because insurance is a grudge purchase.
Yep.
Nobody wants to buy it, but everybody needs it. And we are telling them how much to pay on something that they don't want to buy.
Yeah. And something interesting came out of the Beyond the Build event that we went to is we were talking about soft market. And one of the levers that essentially will pull us out of a soft market is if we have another event, because then it will become apparent that there's more risk out there, and then that would potentially take us out of a soft market and put us back into a hard market, because they'll realize that I guess it puts the actual real understanding the risk to the forefront.
Tell me about what you think the safer path is for the customer.
For me, I just think having an up-to-date valuation makes a lot more sense rather than rolling over and putting 3% on or nothing. I mean, and then essentially the insurers can say what they want to do. They'll say, actually, no, you had a valuation done 3 years ago. We're actually okay with that.
Yep.
Because they're trying to keep customers as well. But the problem is when we do go back into a hard market, there's got to be that catch-up period again as well.
Yeah.
So not only will there be an increase in premium because it's a hard market, but there will also be an increase in the actual the valuation will be up to date. So if there's a valuation that's sitting on that's only is 3 or 4 years old, it's going to be 2 years out of date.
Yeah.
And then so they're going to have that jump to the real valuation, plus also a premium increase on top of that.
Yep.
And as you know, in the industry that we're in, we would rather have smooth curves as opposed to jumping up and down and boom, bust, boom, bust. So I feel like I don't really understand it in the fact that I feel like we're setting ourselves up for that whole boom, bust scenario.
Yep. So what I mean, talk to me about claims and talk to me about how all these other aspects that a good, accurate valuation helps?
Well, it's
A current, accurate valuation.
yeah. I mean, to be fair, it shouldn't really matter whether we're in a soft market or a hard market. We should be insuring for the right amount of cover, and that's it. In a soft market, the premium is going to be cheaper. So it's just the extra cost of engaging with us.
It's not generally going to be cheaper either, is it? The premiums, if they don't get a valuation. We're not saying that the people's valuations go up because they have people's premiums go up because they have a valuation.
Yeah.
It just gives them peace of mind that they're insured probably. If you say that there's going to be a big event and everybody's underinsured, you're only getting what you're insured for.
Yeah, that's right. No, the reason why I said premium is because we had those big increases of 30-40% premium increases, and that's stabilised now. And I guess it's a bit like what we talk about construction costs. It never really goes down. It sort of stabilises for a while, and then it will go up again.
Yeah, they don't come down.
Yeah.
The big thing that I read in last week in there was an article in one of the big media outlets about the Consumer NZ are doing an investigation into insurance premiums going up over the last 20 years. And it's the biggest increases in any product in New Zealand, which is just mind-blowing. So I'm going to keep an eye on that and see where that goes. I'm sure most of our listeners have read that same article. But it's mind-blowing. It's more than supermarkets.
Yeah.
It would be good to understand how a soft and hard market affects that as well.
I mean, we could actually bring along an expert to, not that I'm saying that I'm not an expert, but get maybe an insurer or an underwriter's view as to what they do. I think I read that same article. It said it was like a 900% increase in premium over.
I can't remember the exact, but yeah, there is maybe something that we get somebody in to talk a bit more about that they know. So implications for evaluation services in a soft market are that people are not getting asked for them from a.
They're not being pressured into getting as much as what they were in a hard market.
And the brokers are taking an easy route and just going, right, we don't need to do it, so we'll just take that premium and do that.
Yeah, I think so. Because, I mean, the brokers want...
Which is an easy way to do it. And
they want to keep their clients.
Yeah.
And essentially give them what is perceived to be a win, which is less premium and less
not
cost.
having to pay a few $100 for a rebuild valuation.
So, yeah, that's right. Which is a short-term win.
Yeah, it is. And a lot of commercial building, let's talk about commercial buildings. Commercial building's a business.
Yeah.
In its own right. So the ins and outs of that business are the value of that building.
Yep.
Because it becomes like a business, that whole building. The owners of these buildings are passing the cost on to the tenants. And tenants want a flat. We're a tenant. We're a tenant in this building that we're in. I want a flat price for my OPEX. I don't want my OPEX going all over the place. So that long-term stability, whether it's a soft or a hard market, is actually good for me as a tenant because it means I can plan forward.
Yeah.
So that's a plus for actually get a rebuild valuation because it protects the owner because he knows that his asset's protected. The OPEX is a couple of $100 a year extra. Well, he should be covering that. It should be his forward plan on it anyway.
Correct. Yeah. And if they, like with us, they can get an update every year on their sum insurance valuation or every 2 years.
Yeah.
It just softens the blow.
Yeah.
And it doesn't matter. It shouldn't really matter what market it's in.
Yeah.
It's still the same. If you have a loss, you have a loss.
Yes. Yep.
And there's no clause in there. However, if it was during a soft or a hard market, these are the conditions. It's the same conditions.
Yeah, absolutely.
And if you're going to be underinsured, you're going to be underinsured.
So what we're saying at the moment is that of what I'm hearing from what we're talking about is that the insurers are saying it's a soft market. We're buying insurance cheap, so we're just going to sell you it cheap, and we don't need any of that risk covered off because we've got a bit more appetite for risk because it's a soft market.
Yeah, it's a bit more appetite. They're still pretty risk averse.
Yeah, well, that's insurance, isn't it?
Yeah. But they're more susceptible to let things slide for another year than what they were 2-3 years ago.
But as you say, that tap can go off as quick as it's come on.
Yeah.
If something happens, and then the everybody's getting asked to do a rebuild valuation the next time round.
Yeah.
They've saved themselves a few $100. But if they're leasing out the building, they should be passing that on to the tenant anyway. And it'll be in their ongoing running costs of the building, and it'll be in their OPEX.
Yep.
And the potential saving in their OPEX is the fire service levies on our valuations anyway. So it's a bit yin and yang on it, isn't it?
Yeah, it is. And we're finding the good experienced brokers that we're dealing with that's the mindset that they've got.
I know this subject's a bit controversial, but and it's more, we're asking the questions because Brett and I really don't understand how we're here and how it all works. Is that fair to say, Brett?
Yeah, this is essentially a live discussion.
Yeah, exactly.
This is a repeat of a discussion over a coffee.
Yeah, well, we sat and had a chat about it the other day there, and I said, let's do, or Brett said, let's do a podcast about this and put it forward. And we're like, yeah, because neither of us really know the answers. And if you know the answers, please write in, subscribe, and tell us what the answers are, and come on the show and tell us, because we really want to understand.
And part of that discussion is we're trying to work out how we can help clients, brokers and insurers through this market that we find ourselves in at the moment.
Let's tell the listeners what we talked about and what you came up with some solutions.
Okay. Yeah, and if you see Andy's face go red, that means he's just making stuff up.
He's right, because he's probably about to give some money away, and I don't know about that.
I might use the discount word. So one of the things is obviously cash is a bit hard to come by these days, and we're just trying to work out better payment options or potential better payment options that we can do for our product, because we think it's important that people still get our product. And we do have a 4-year payment plan that we currently run in the commercial space.
This had a really good uptake on more body corps and things.
Yeah, body corps like that, because it's stable, and they know how much is coming out every year for 4 years. So that's over a 4-year period. So rather than paying, let's say for argument's sake, $1,000 up front and $500 at the 2-year renewal, it's $1,500 divided by 4. And then we had a discussion about maybe looking at another option in residential potentially. The other thing is moving forward, we quote commercials. If anybody gets a quote from us and they log into it and use our online system, then potentially we can give a 10% discount. Is that the word? 10% off the cost of it.
Yeah, we'll just give a discount away. So you've heard it first. Brett's giving away 10%.
Yeah.
So how does that work, Brett? Tell me how
I don't want
works.
too many people to take it up because it's coming out of my salary.
I was going to say that.
We're giving away our podcast listeners an exclusive offer. Get 10% off a commercial rebuild valuation when you mention the discount code REBUILDCONFIDENCE when you book. To qualify, you must accept the quote within 20 working days of issue. The offer is valid from now until the 31st of December 2025. It's that simple. Book a commercial rebuild valuation, mention the code REBUILDCONFIDENCE and save 10%. If you've already engaged in a scheme with construction cost consultants, this obviously doesn't apply.
That's a good idea. Look, you heard it first. I heard it first. I've picked myself off the floor, Brett, and that'll come out. I'll tell all the staff that they're not getting a Christmas do this year because Brett's just giving you guys all the money.
Can you guys on the camera follow us for another half an hour after this podcast to pick up the real deal? But things like that, we're just looking for an angle where we can help in a struggling market.
Awesome. So that's a really good rundown on where the market is: soft market, hard market, how we understand it works,
how we interpret it,
and it's not how it probably works, but it's how we see it and how we interpret it. So please don't start shouting at your radio or shouting at your screen. It is in how we interpret it.
Yeah. Well, it's all our family that are watching it anyway, Mitch. Don't bring it up at birthdays and anniversary things.
My grandson's my biggest fan. Awesome. Thank you, Brett.
Cool.
It's good to get back around the table and have a bit of a chat about these things. And it is a hot topic for us in the office at the moment.
It is. Yeah.
Just trying to understand a bit more. Thank you.
Awesome. Thank you.